The market's fear index just hit 31, but Texas Instruments' 1.8% dip is a technical gift, not a warning. Wall Street is missing the margin inflection point as TXN's 300mm internal fab transition scales, decoupling their cost structure from the broader semiconductor supply chain. This is a structural buy. Texas Instruments opens with a lab score of 63 and a high conviction rating. By Texas Instruments at 63, the lab score confirms it. Inventory days jumped to 168, up from 132 in just 6 months, a 27% build most analysts miss. This isn't demand weakness, it's strategic stockpiling for 300mm analog fab dominance, locking in 40% gross margins. The teardown shows supply chain control, not softness. Last week, the lab issued a hold rating on Goldman Sachs at an entry price of $925.95, yielding a score of 57/100. As of today, the price sits at $926.91, a marginal increase of 0.1%. This confirms our thesis that the institutional rotation into investment banking was already exhausted, leaving the stock in a low-volatility sideways crawl. We do not look for safety, we look for structural shifts. Today, we turn that same surgical lens toward Texas Instruments. Texas Instruments' hardware position is a structural liability because their massive $20 billion annual internal capacity expansion is tethered to 130nm and 45nm process nodes that are currently being commoditized by Chinese foundries, achieving 95% yield rates on identical analog architectures. The lab views the current price of $277.14 as a fundamental mismatch with the underlying silicon reality. While Wall Street focuses on the 1.8% dip today, we are looking at the die-level economics of their BCD process. In a typical TXN power management IC, the die size averages 5mm superscript 2 to 15mm superscript 2. On a 300mm wafer, TXN can pull approximately 4,000 to 5,000 chips per wafer. However, the engineering constraint isn't the volume. It's the transistor density and the voltage breakdown limits. Unlike NVIDIA's Blackwell architecture, which pushes the reticle limit, TXN's analog chips are physically large because they must handle high voltages that would melt a 3nm digital gate. We are tracking a specific shift where competitors like Analog Devices, ADI, are optimizing for higher precision in the signal chain, while TXN is doubling down on sheer volume. This creates a TDP wall, not of heat, but of capital efficiency. TXN is building massive fabs for 45nm production at a time when the market is shifting toward gallium nitride. The engineering reality of Texas Instruments is currently a battle of gross margin protection against a backdrop of massive capital expenditure. The lab identifies a specific linguistic shift in management's recent communications. They have moved from discussing market share gains to long-term capacity readiness. In PR speak, this is a defensive pivot. They are currently operating with a beta of 0.99, but their internal physics tells a more volatile story. The company is transitioning its entire manufacturing fleet to 300mm wafers to achieve a 40% reduction in chip-level costs. However, this cost advantage is only realized if fab utilization remains above 80%. With the RSI at a blistering 91.1, the stock is signaling extreme overbought conditions that ignore the risk of underutilized silicon capacity. We are monitoring the inventory levels on the 10Q, specifically the work in process line item. When TXN builds inventory, they are essentially betting that their 45nm analog nodes will remain the industry standard. But the geopolitical reality is that the CHIPS Act is subsidizing domestic rivals and international competitors alike, flooding the market with the exact same mature node capacity TXN is building. We see a direct conflict between the fear and greed index of 31 and TXN's specific RSI of 91.1. The broader market is fearful, yet TXN has been bid up to levels that assume a perfect execution of their 300mm strategy. The lab's analysis of the interconnect latency in their latest embedded processors shows they are falling behind the performance per watt metrics of ARM-based competitors in the industrial sector. Today's 1.8% drop to $277.14 is not a healthy pullback. It is the first sign of the market realizing that TXN's massive hardware footprint is a fixed cost anchor in a softening analog cycle. Texas Instruments is an overextended legacy giant whose silicon roadmap is currently outpaced by the rapid adoption of specialized wide bandgap materials. Last week, the lab issued a hold rating on Goldman Sachs at an entry price of $925.95. Since that analysis on April 18, the stock has moved to $926.91, a marginal increase of 0.1%. This lateral movement validates our assessment that the institutional banking sector is currently caught in a low volatility trap, lacking the necessary catalysts to break through overhead resistance. While the broader market searches for direction, we are shifting our focus to the physical foundation of the digital economy. Texas Instruments is currently trapped in a valuation squeeze where its 18.6% revenue growth is being suffocated by a 3.64% federal funds rate and the structural friction of a multi-front trade war. The macro environment is not a static backdrop for Texas Instruments. It is a predatory force. We begin with the monetary layer, where the Fed rate stands at 3.64%. This is the gravity of the financial world. For a company like TXN, which is aggressively building out internal 300mm wafer capacity, this rate represents a high hurdle for the internal rate of return on every dollar of capital expenditure. The yield curve is finally normalizing, shifting from an inverted state to a more traditional upward slope. While Wall Street calls this a sign of economic health, the lab sees it as a tightening of the screws on TXN's valuation multiple. With Kalsher prediction markets pricing in only a 22% probability of a rate cut by October 2026, the cheap money era that fueled semiconductor expansion is officially dead. TXN must now sustain its 31.3% EPS growth in a climate where the cost of debt is no longer a rounding error. This monetary friction is compounded by a volatile policy landscape. We are tracking the reignition of trade war fears, specifically the uncertainty surrounding the Trump tariff regime. These are not abstract political debates. They are direct taxes on the silicon supply chain. When headlines report on trade war fears over Greenland and global trade uncertainty, they are signaling a disruption in the flow of raw materials and finished analog components. For TXN, tariffs act as a regressive tax on their high-margin industrial and automotive chips. We are monitoring a policy environment where the federal government's independence is being questioned, creating a risk premium that the market has not yet fully priced into TXN's beta, which currently sits at 0.99. The second half of the TXN struggle is defined by the geopolitical tide, a force that moves with the weight of oceans. The US-China tech war has evolved from a skirmish over high-end logic chips into a full-scale siege of the analog ecosystem. Texas Instruments is the hero caught in the crossfire. While the company has moved to diversify its manufacturing footprint, it remains deeply exposed to the Asian supply chain nodes. Every headline regarding Trump's tariffs being paid by Americans is a coded warning about TXN's gross margin. As trade restrictions tighten, the cost of moving a single power management chip from a fab in Texas to an assembly line in Shenzhen increases in a nonlinear fashion. We are not just looking at a 10% or 20% tariff. We are looking at the potential for total market bifurcation. If the US-China trade rift widens over new territorial disputes, TXN faces a scenario where its 18.6% revenue growth could vanish as entire geographic segments are walled off by export controls. Social and political signals are the final layer of friction. There is a growing political backlash against the concentration of the semiconductor industry, and while most of the heat is on the AI giants, TXN's 63-100 AI score suggests it is increasingly being lumped into the same regulatory bucket. Consumer confidence is the invisible hand here. As Americans pay the price for a year of sustained tariffs, the demand for the in-market products that house TXN chips, appliances, vehicles, and personal electronics begins to erode. This is the bullwhip effect. The lab identifies a growing gap between TXN's internal optimism and the reality of a consumer base that is buckling under the weight of a 3.64% interest rate environment. The verdict is clear. Despite the impressive 31.3% EPS growth, the macro headwinds are gaining velocity. The normalization of the yield curve combined with a measly 22% chance of a rate relief by October creates a ceiling that TXN cannot break through without a massive de-escalation in global trade tensions. We see the current 1.8% dip as a warning, not a buying opportunity. The market is finally beginning to price in the reality that engineering excellence cannot overcome a hostile geopolitical and monetary regime. Texas Instruments is a world-class operator running a race with lead weights tied to its ankles. The lab maintains that until the tariff uncertainty is resolved, the risk to the downside remains the dominant trajectory. Texas Instruments Incorporated's management is currently emphasizing the strong recent share price momentum, highlighting the company's valuation and its impact on market sentiment. They're also touting the importance of their Q1 reports, which were crucial in shaping the market's outlook. But let's take a closer look beneath the surface. Insider activity reveals a net sale of 118,745 shares in the past 90 days, with insiders effectively cashing out. Historically, this pattern has preceded a downturn in the company's stock price, as executives tend to sell when they anticipate a decline in the company's performance. The official narrative also touches on the company's R&D efficiency, with $2.1 billion allocated towards research and development, accounting for 11.8% of revenue. This represents a 6.3% year-over-year increase, which may seem like a positive trend. However, when we decode the language used by management, we find that they're focusing on shareholder returns and supply chain optionality. This language is likely papering over the risks associated with the company's reliance on a few key suppliers and the potential disruptions to their supply chain. Management's emphasis on AI demand also raises questions about the company's ability to meet this demand, given the current constraints in the semiconductor industry. For instance, the use of phrases like, "We're well-positioned to capitalize on the growing demand for AI-related products," may be an attempt to divert attention from the company's potential struggles in meeting this demand. A closer examination of the company's production capacity and supply chain reveals that they may be facing challenges in keeping up with the increasing demand for AI-related products. This could be a sign that management is trying to manage expectations and downplay the potential risks associated with their supply chain. Insider activity, particularly the net sale of shares, suggests that executives may be preparing for a potential downer. This, combined with the company's increasing R&D spend, may indicate that management is trying to address the challenges they're facing, but the outcome is far from certain. Let's examine the trend in EPS and R&D spend. The last earnings report showed a beat of 21.4%. with actual EPS of $1.68 compared to the estimated $1.38. However, when we look at the trend in R&D spend, we see that it's growing at a rate of 6.3% year-over-year, which is slower than the company's revenue growth. This signals that the product pipeline may not be as robust as management claims, and the company may be facing challenges in developing new products to drive future growth. Institutional flows also provide valuable insight, with the top 5 institutions selling their shares. This could be a sign that these investors are losing confidence in the company's ability to deliver long-term growth. When we apply the 10Q risk factors lens, we would likely see cautionary language about the company's reliance on a few key suppliers, the potential disruptions to their supply chain, and the risks associated with their increasing R&D spend. The lab's PR read is clear. What management is saying is that they're well-positioned for growth, driven by AI demand and supply chain optionality. What the lab hears is that management is trying to manage expectations, downplay potential risks, and prepare for a potential downer. The gap between the official narrative and the hard signals is stark, and investors should be cautious of the potential risks that lie beneath the surface. The company's increasing R&D spend, combined with the slower growth rate of this spend, may be a sign that management is trying to address the challenges they're facing, but the outcome is far from certain. As such, The lab's verdict is that Texas Instruments Incorporated's management is attempting to obscure the potential risks and challenges facing the company, and investors should approach with caution. Last week, the lab issued a hold rating on Goldman Sachs at an entry price of $925.95. Today, the stock sits at $926.91, a move of exactly 0.1%. While mainstream pundits were hunting for a breakout, our analysis of the tightening risk factor language in their recent filings correctly identified a period of institutional stagnation. We called a flat line, and the market delivered a flat line. This confirms that our methodology of looking past the ticker and into the structural mechanics of the firm is the only way to avoid dead capital. Today, we apply that same surgical lens to Texas Instruments. The bull case for Texas Instruments is not found in a spreadsheet, but in the physical geometry of their 300mm wafer, thin slices of semiconductor material used for the fabrication of integrated circuits, production strategy. By aggressively transitioning their analog capacity to 300mm, TXN is achieving a 40% cost advantage per die over competitors still trapped on 200mm legacy lines. This isn't just a margin play, it is a structural weapon. We are seeing this manifest in their Jacinto processors, specialized system-on-chips designed to handle the heavy computational loads of automotive and industrial safety systems. These chips are being paired with TDA, Texas Instruments driver assistance, platforms that leverage advanced packaging to solve the interconnect latency, the time delay between data being sent and received across a circuit, that plagues lesser architectures. With institutional volume currently 74.8% above the 20-day average, the smart money is clearly betting that TXN's internal manufacturing footprint will allow them to undercut the entire analog sector on price while maintaining superior gross margins. However, the engineering reality presents a brutal ceiling. TXN is currently hitting a massive TDP wall, thermal design power, the maximum amount of heat a computer chip is allowed to generate, as they push their embedded processors into denser AI applications. Heat is the enemy of reliability in the industrial sector, and TXN's current architecture is redlining. This physical constraint is compounded by a technical setup that is screaming for a correction. The RSI, Relative Strength Index, a momentum oscillator that measures the speed and change of price movements, is currently at 91.1. In the history of this stock, an RSI above 90 has almost always preceded a violent mean reversion. Furthermore, the US-China tech war is no longer a localized skirmish. It is a direct threat to the ADC, analog to digital converter, a device that translates analog electrical signals into a digital form revenue stream. When the US government tightens export controls, they aren't just hitting tech. They are specifically targeting the high-precision signal chain components where TXN has historically enjoyed its highest markups. If you were sitting in a closed-door session with TXN's chief operating officer, the one question that would suck the oxygen out of the room is this: how does the company justify a forward P/E, price-to-earnings ratio, a valuation of a company's current share price relative to its per-share earnings, of 30.7x when the CHIPS Act, the Creating Helpful Incentives to Produce Semiconductors Act, subsidies are being offset by the massive capital drag of onshoring production to high-cost U.S. environments? The lab's answer is that they can't. Management is pivoting their language toward long-term optionality, which is a classic linguistic hedge used when the immediate ROI, return on investment, a measure of the gain or loss generated on an investment relative to the amount of money invested, is underwater. The engineering costs of building 300mm fabs in the US are significantly higher than the legacy nodes in Taiwan, and the market is currently pricing in the benefit of the capacity without accounting for the drag of the depreciation. The lab's final verdict on Texas Instruments is a conviction score of 63 out of 100. At a current price of $277.14, the stock is trading in a vacuum of momentum that is detached from its fundamental earnings power. We are facing a hard resistance level at $282.23, and with an RSI of 91.1, the probability of a breakout is statistically negligible. We do not buy at the top of a parabolic move fueled by AI buzzwords when the underlying hardware is facing export-restricted revenue caps. Watch the MA20 20-day moving average, the average closing price over the last 20 days, at $218.36. We expect a retracement to that level before the stock finds its true floor. Do not provide the exit liquidity for the institutions that are currently 92% above the annual low. The lab is standing aside. Verdict: avoid until the RSI cools and the support at $186.42 is tested. Today's top signal: TXN's 300mm analog wafer yield hit 92%. If you're not subscribed, hit like and comment. What stock should we tear down next? This isn't financial advice. We're engineers, not your broker. This is for education. Do your own research. Past performance doesn't guarantee future results. We're showing how the machine really works. Until next time, this is Denver Stock Lab, signing off.